Welcome to 2026. It is Monday, January the 5th, and this is Markets with Megan. Thank you so much for all the support and listening to our podcast that we got in 2025. And we look forward to giving you more up-to-date economic information, market-moving events, and what all this means for your investments in the upcoming year. If you like this podcast, you can subscribe, hit that alarm bell that you see, or share it with your friends, any family members, or colleagues that just want to try and make some sense out of the underlying story, not necessarily some of those headlines that we see in the news that move the markets. Let's get started. We thought we'd kick off the year with giving a review of what we saw in 2025, which was quite an impressive year from an investment perspective. First of all, the U.S. economy, despite the many headwinds, we had the longest government shutdown on record. We had a complete uprooting of global trade. And then we also had basically muted job creation. All of this, we still were able to produce almost 4% growth in the second and third quarter this year. And economic growth is on pace to post about 2% growth for the year. Now, from a economic perspective, the job creation, as we mentioned, was small. When you look at the amount of jobs that were added for the calendar year, it was the least amount of jobs since 2020 when we were dealing with the pandemic fallout. The unemployment rate also rose to a 5-year high. Inflation, which is a major thing the Fed's watching, as well as the labor market, that was stubborn. It's still growing well above the Fed's target. The core prices in this economy are growing about 2.8%. We also saw the consumer continue to be resilient, and this is a big diversion from the confidence readings that we've seen throughout the year. Consumer confidence continued to be weak. Real disposable income only grew about 1.5%, but yet consumer spending was very strong, especially in those quarterly GDP numbers. Now, what does that all mean from an equity and bond market perspective? Well, equities really cheered the economic weakness, not necessarily because the economy was weak, but because the Fed was able to cut interest rates as well as some other global central banks. This helped fuel that momentum rally we saw in technology and gold. These things also led the market to actually get some dispersion outside of the U.S. We saw some rotation into the international markets. When you look at the MSCI All Country World Index, which looks at all of the global equity markets, and then you strip out the U.S., that index actually outperformed the U.S.'s major index here, the S&P 500, by the most since 2009. So we did start to see some rotation out of that technology trade. Within the U.S., we saw the rotation into some of those small and mid-cap names. These are the areas of the market that have lagged this large-cap growth tech rally. Well, in the second half, we saw some rotation there. But internationally, it was really led by the European markets and the emerging markets specifically. We saw big outperformance from countries like Brazil, Mexico, Korea, Taiwan. All of this was around some of that tariff tension starting to ease and some clarity there. We saw some big rebounds there in those markets. From a fixed income perspective, it was the third consecutive year of bond returns for investors. We saw this primarily in the global markets, though. The global aggregate index, excluding the U.S., was higher. And then we saw emerging market debt outperformed. All of this was on, again, easing tensions, lower central banks, a weak dollar. This helped investors go internationally, not only for equities, but also for bonds. We also saw here in the U.S. credit continue to outperform treasuries. We've seen that extra yield or spread that you earn over treasuries to take on that risk of buying high yield or investment grade debt, that continued to shrink. And we've seen now 3 consecutive years where both investment grade and high yield outperform treasuries. We haven't seen that since 1995 to 1997. But the main story for the year was really the precious metals. We saw commodities higher. The commodity index rose, but it was all precious metals. It overshadowed that weakness we saw in grains and crude oil and cocoa. We saw gold make over 50 record highs for the year. Silver prices rose over 100%. A lot of this has to do with geopolitical uncertainty, tariff uncertainty, a weak U.S. dollar, central banks cutting rate, and also some of these precious metals have been roped in with this momentum trade, the fear of missing out. So we're seeing that we saw the precious metals have a significantly good year last year. Now, we look forward to this year coming back to you with all of the economic data. We'll be back regularly a few times a week to update you guys on any market-moving events as well. And again, if you want a history of our podcast, you can go to marketswithmegan.fm. Thank you.